Alright, so chapter 16, probably should have started with this chapter, since, as the title indicates, this is kind of an introductory chapter to managerial accounting, just kind of getting down some of the concepts and terminology. Alright, so anyway. So here they give you kind of a basic framework of what management accounting is about, and it's really to help managers and other employees within a company to make good or better decisions. And so a couple of things involved here is, first of all, you have to figure out how to, or you have to decide who has decision-making powers over certain assets within the company. And then what the accounting information does is help those managers who have authority over certain assets plan and make decisions about how those assets are used or utilized. And what you get back, both those up above the managers who have authority over these assets, and also to the manager themselves, is you get accounting reports. And so these accounting reports provide a means of monitoring, evaluating, and rewarding performance, or possibly not rewarding performance, depending on whether or not performance is good or bad. And so, again, this is part of that system framework we talk about. A lot of what happens occurs through what we call budgets. Budgeting is a big part of what companies do. They try to budget their resources. They try to budget what their revenue stream is going to be. They try to budget what their expense stream is going to be, and they try to, through these accounting reports, control those things throughout a certain period of time. All right, so budget plans, they plan for the future. As we talked about, these budgets usually are over certain areas of the company. Of course, there's an overall budget that we'll talk about, but the overall budget is made of smaller budgets in certain areas. And again, what you do is through these accounting reports, you're getting these reports, and a lot of what happens is they're comparing the current either revenues and expenses, or just sometimes departments have only expenses. They're comparing current with budget, and the manager and those above the manager can determine whether or not they're staying within budget or somehow they're over budget. And if they get these reports often enough, they can make adjustments as they go along so that they can correct any discrepancies. And of course, again, at the end of the period, you get a final results of budget versus actual results, and they can be either favorable or unfavorable, and so the people above the managers can evaluate their effectiveness. Now, you've probably had some experience with this in your financial accounting. Financial accounting has a different focus than managerial accounting. Financial accounting is all about providing financial information on the performance of a company over a certain period of time, usually 12 months. It's the four functional financial statements: balance sheet, income statement, statement of owner's equity, and statement of cash flows. Seems like they left one off here. Yeah, statement of owner's equity or shareholders' equity. Recall that in financial accounting, you gotta report your financial results according to a set of rules called Generally Accepted Accounting Principles, GAAP. And of course, the governing body that promulgates GAAP is called FASB, Financial Accounting Standards Board. The reporting entity is the company as a whole. You don't report on various segments, at least in these four financial statements, although you might report on segments in the notes to the financial statements. The time period, usually a year, but for public companies, they're also required to submit quarterly reports. You don't see much monthly reporting. It's just too expensive. The users, that's a big difference. The users of financial statements primarily are third parties who are not involved in the day-to-day operation of the company. Investors, potential investors, creditors, etc., regulators. Managerial accounting, whole different focus. Provides information for planning, evaluating, and rewarding performance. These reports might be standard, they might be internally generated. There's really no rules. There's no gap for managerial accounting. It's whatever the company needs in order to make better decisions. So any type of reports that they want to custom make to serve their needs, that's just great. Reporting entity. Well, usually, like we talked about, this is broken down into different segments of the company, usually by departments. Time period, any period. We'll talk about how we budget and what time periods we budget for. Users, management, customers, and others in the value chain. This could go actually outside of the company. We'll talk about the value chain and the players that are involved in the value chain. Accounting for manufacturing operations. Now, of course, this is a little different than if you are, your company is a merchandiser. If you're a merchandiser, you simply buy the product from someone else, usually a manufacturer, but it could be middleman, and you just turn around and sell the product. But the key there is you don't make the product yourself. Walmart's like that. They are a merchandiser. They don't make the stuff they sell. Well, manufacturing operations, totally different deal. They take materials called raw materials that they produce. Shit. God damn it.